So far this summer, the weather hasn't been really the only hot thing, with Q2 also finishing higher. So today we're going to dive into our previous quarter market review, forecast for the rest of the year, and our themes going forward. But first, I've got an exciting personal update for everybody. So on July 6th, my wife and I welcomed our son, Jack Barnhart, into the world. Rest assured, I have not taken my eye off the ball, and if anything, this has only increased my motivation to take care of my clients, which is why I'm probably making this video only 4 days later here. So one other housekeeping item: if you are a client, you're surely being bombarded already with communication from TD Ameritrade and Charles Schwab regarding the upcoming merger. Now, there's no action required from you at this time, and the transition really should be super straightforward, slotted to take place at this point over Labor Day weekend. For my clients from back in the Scottrade days, this is old hat for us. So please know that when the time comes, I'm going to reach out to each of you individually, basically just to ensure that the transition is super smooth. So nothing you got to do right now. Okay, so back to the markets. This past quarter, when we saw the threat of an unprecedented U.S. default hanging like a cloud over the market due to the contentious debt ceiling negotiations, and it sounds dramatic, right? And almost like a plot of a blockbuster political thriller. But guess what? Unfazed stock market indices, they kept their cool, and we continued that steady climb upwards, and we shrugged off a potential source of a big market decline. And one of the main plot twists this last quarter was led by a select group of heavyweight tech companies. These companies really capitalize on robust earnings and the undeniable allure of AI, leading to an upward trend which many of our clients were well positioned for with our overweight to technology to start this year. Now, this strong surge in enthusiasm for tech really helped growth stocks outperform relative to value stocks. And let's not forget that value stocks really had to deal with the additional burden of disappointing returns from energy stocks. And where was the market anxiety meter? The VIX, right, in all of this. Surprisingly, the VIX settled below 14 at the end of the quarter, hitting at really a return to calmer pre-pandemic waters. Bonds had sluggy, jumpy performance, revealed a level of maybe investor anxiety, with most U.S. Treasuries and corporate bonds also ending the quarter with lower prices but higher yields. Now let's focus on how our investment approach performed in the landscape from last quarter. For many of our clients, we actually outperformed relative to their benchmarks for the last quarter, with equity-heavy strategies specifically taking the lead, both from an absolute and a relative perspective. Now, the primary drivers pushing the returns above the benchmark were our overweight positioning again in technology stocks and a preference for quality and growth over value. That said, obviously each client we have is invested unique to their goals and risk tolerances, and is by no means advice or promise of any individual returns. Results may vary. Now, our active decisions to limit exposure to struggling bank, small cap, energy stocks, that also bolstered overall relative performance for the last period. However, it wasn't all roses. Detractors to absolute return from really was due to our exposure to broad bond markets, international developed market stocks, and to a lesser extent, some emerging market stocks. So that's the wrap up for the last quarter. We weathered some storms with the debt debate, and we made the most of tech's robust earnings. We navigated a lot of market anxiety. So despite the roller coaster ride, right, we got to remember that volatility often brings opportunity. So as we reach the midpoint of 2023, I think we're reminded yet again that we're operating in a world that's different from what we've known in the past. So I'm going to now cover the three main themes that should guide our investment outlook for the rest of the year. 1, holding tight. Number 2, pivoting to new opportunities. And 3, harnessing what I like to call mega forces. So let's talk about some recent macroeconomic developments and how they connect specifically to our investment outlook. So there's been some interesting movement in the euro area, specifically in terms of inflation. Just last week, or 2 weeks ago rather, flash estimates indicated a dip in the euro area headline inflation for June, primarily driven by energy prices dropping below last year's levels. But that's not all. Let's take a look at core inflation. Surprisingly, Core inflation was even lower than expected too, but it did see a slight increase going up to 5.4% year over year. Now, over recent months, inflation has shown signs of softening, and we anticipate further cooling in the second half of this year. However, there's a plot twist here. Policymakers are still on edge. And why is that, right, you might ask? Well, the pace of core inflation is still hovering above the ECB's 2% target. That's where they want to get inflation to, thanks to more ongoing supply constraints. Now, the ECB is concerned that last year's high inflation could spur bigger wage demands, thereby creating more stubborn inflationary pressure holding things down. And this leads us to the connection back to our mid-year outlook. The ECB, along with other major central banks, is feeling really the heat to keep the policy tight, even at the risk of hampering activity, right? People spend less money when interest rates are higher. It's harder to borrow money. Now, you can see here during each recession in the vertical gray bars that the Fed has responded by cutting rates in the yellow line. Now, when you flick on the news today, the reason you'll see volatility in the market bouncing around every day is because the market is trying to price in expectations regarding rates. And the problem with this is trying to predict the Fed rate path on a proactive basis when the Fed is actually making decisions on a reactive basis on data that's historical, that comes out after the fact. So what do we do in such a scenario? And that's where our second theme comes in, pivoting to new opportunities. So when things are volatile, the spectrum of security performance broadens, right, relative to the broader market. It's kind of like a treasure chest, right, almost like of opportunities open up. And in this environment, we can generate returns by being much more granular and focused with our exposure. So if we dig deeper, we research more, and in doing so, we can potentially pivot to new opportunities. And now it's time for our third theme, harnessing megaforces. So megaforces, right, sounds pretty powerful, right? And really they are. They are the structural changes that can cause seismic shifts in profitability across economies and across sectors. So we're talking about things like artificial intelligence, the reshaping of globalization due to geopolitics, and the all-important transition to the low-carbon economy. So the key here, as any seasoned investor will tell you, is to identify the catalysts that can supercharge those megaforces. And of course, to figure out if all of this is already being priced in by the market today. So first up, we've got AI, artificial intelligence, and it's rapidly transitioning from just a buzzword to a mainstream reality, disrupting a lot of established sectors and economies in the process. And the recent really explosion in computational power and data availability has supercharged the ascent of AI in recent months. And if you've been keeping tabs on company earnings and releases calls this year, you'll know that AI has been on everybody's lips. But there's more to AI than just tech. Markets have been quick to price in AI's positive impact to the IT sector specifically, but the benefits of AI, in my mind, can permeate other sectors as well, which is why I think we're starting to recognize AI as a megaforce within the granular views in the positioning we have in portfolios. Now from AI, we can move on to a different kind of change. We're also seeing a world that prioritizing national security over efficiency of global trade. So in that type of landscape, the competition specifically between the US and China seems to be a big driver of any fragmentation. Now, while I think a total decoupling, right, is unlikely, I think we could all agree that it makes sense that a more competitive landscape is going to exist going forward and be fueled by more investments in tech. So alongside this geopolitical landscape, there's another global shift that I don't think we can ignore. And it's, really has to do with the world progressing towards this low carbon future, with many countries providing strong incentives to accelerate that transition and subsidize things. And regardless of what you believe politically, I think we've got to be aware that the most likely path towards this low carbon world and be cognizant of it, including the potential portfolio impact. Electric vehicles, they're a case in point, as the chart shows here. Let's now turn to a more demographic matter. Population dynamics are shifting significantly. The working age population in high-income economies is set to decline in the coming years, posing a range of economic and social challenges. Fewer workers will be supporting a larger non-working population. That's going to influence government spending, debt, and tax revenues. Now, despite these challenges, I see plenty of investment opportunities. Healthcare, real estate, leisure, and other companies targeting seniors with products and services are all promising sectors. So, in my mind, we should consider also not only how these companies, but other countries and companies are going to be adapting to that demographic shift, kind of like we've seen with France, increasing that retirement age from 62 to 64 earlier this year. So there you have it, an overview of some of the most potent forces shaping our world today.